Welcome to Talking Personal Wealth Management podcast. My name is Leah Crowley, and in this series we're taking a look at a range of topics that you might know a little bit about but want to get a better understanding of. We explore all areas of personal wealth management, including investing, estate planning, financial advisory, self-managed super funds, insurance, and financial life cycles. Today, we'll be talking to Andrew Yee, Director in the Personal Wealth Management Division, specialising in superannuation. We want to be talking about self-managed super funds. Andrew, how are you?
Not bad. How are you, Leah?
Very well, thank you. I've got so many questions for you. I hope you're ready to provide all the answers.
I'll try to.
Okay, well, that's good. That's good. That's the bargain that we're going to go for.
Okay.
Firstly, right, so we all know what superannuation is. Like, we've got that. Everybody, if you've worked anywhere at any point in time, the chances are you have some sort of super fund. But what's the difference between a self-funded super fund and the one that, you know, most people have, those public funds?
Well, a self-managed super fund is a separate tax entity, so similar to a trust or a company, but it's to do with holding one's retirement benefits. So as opposed to a public offer fund where it's open to everyone, and everyone can put their money into this one big pooled fund, where a self-managed super fund is a private fund which individuals just set up themselves to place their superannuation in. It's a separate legal entity and it's operated by a trustee. So it's very similar to a trust structure, but it's designed to hold your retirement benefits. And with that, there's all these additional rules that apply to the members. So even though you've got this structure, there's a lot of restrictions in how you can operate it. And with a self-managed super fund, it's very popular for your mum and dad. So in a fund, you can only have now up to 6 members. So it was 4, and it was very attractive to the family. So it's really designed for the mum and dad and possibly 2 children. So with the increase in 6 members to 6 members now, if you've got a family with more than 4 people, you can add members to that fund.
So it could even be multi-generational.
Correct. That's right. And with a self-managed super fund, the unique part of it is that you are in control of your own superannuation benefits. So you're in charge of what you invest in and when you make payments to members or when contributors come in. So you're in full control. So you're administering the fund, you're looking after their investments. So that's why it's also called do-it-yourself funds, because you're doing it yourself rather than you're getting the fund managers to do it for you or your superannuation companies to do it for you. It's geared towards people having control, people having flexibility in controlling what they invest in for their retirement.
Yeah. And you said that most people who start a self-managed super fund are like mums and dads, that kind of thing. So is it unusual for someone in their 20s to start one, or is it more sort of you're of an age where you're established and your personal wealth is established that you would set one of these up?
Yes, generally most people that set them up are probably after age 30. You don't get many people setting them up in their early 20s, because that's probably where they're at a stage of life there where financial affairs and superannuation in particular are not that interesting for them. Although the data is showing now that people are setting up funds earlier in life, but generally they normally set up funds where they're in a stage of life where their superannuation is at a fairly decent level. So, and they're probably paid off their mortgages or paid off. Right. They're no longer paying school fees. So they're in a financial position where they have a decent amount of super and they're looking at being further engaged in their financial affairs. So a self-managed super funds, because it's a separate entity, there needs to be a certain fixed amount of cost to operating them. So if you've only got a small amount of super, it doesn't make sense, or it's not cost effective to set up your own fund, because there's certain a level of fixed costs that you have to outlay to operate your own fund. So generally speaking, self-managed super funds, for those are, well into their financial stage of life, it gets more, they're more popular when, you're at your pre-retirement stage or in retirement stage. So you're drawing money out of your super. That's when you have a fairly decent amount in super, and that generally makes it worthwhile to have your own fund.
And you were saying sort of that there's a sense of control. You control it all yourself, but with control comes a lot of work, right? Is there a lot of work in maintaining it?
Oh, it can be. You can do as little as you want, or you can be engaged as you want and do as much as you want. So obviously, being a tax entity, you've got to do a certain number of annual compliance filings. So you need to arrange for financial accounts to be prepared. You need to have those accounts audited. You need to file annual tax return. Mm-hmm. And if you've got a corporate trustee, which I think we'll discuss later, you need to file with ASIC on an annual basis. So, as a minimum, you've got to do these annual compliance things. And then you've got to look at, what do I invest in and how do I invest? And then you've got things like contributions and making benefit payments. You need to be administering the fund on a day-to-day basis sometimes.
Yeah, right.
So it can be a lot involved, and you're ultimately responsible for that fund, because you're in control. You're a member, but you're also the trustee. So ultimately, you're responsible, and you need to be across everything, including the laws that relate to tax and superannuation. So it can be a lot involved, but quite often people they outsource a lot of these things. So they get other people to invest on their behalf in the fund. So they might have financial advisors, they might have stockbrokers, they might have investment advisors to do all the investing for them. They might have an administrator to run the fund for them. They might have their accountant. Normally accountants get involved to do the accounts and file the tax returns, and then they'll have the auditor. Obviously they can't audit the fund themselves, so they need to have an auditor.
Yeah, right. And is that an annual thing? The auditing as well?
Correct.
Yeah, okay.
Yes. So it really depends on the individuals, on how much they want to get involved. A lot of it can be outsourced, and they don't have to do much at all.
So with the setup, is there somebody that you'd be best off going to, even just to be like, oh, Andrew, I'm interested. How do I start? Like, is it the kind of thing that you would be the best person to come to? Yeah,
generally people don't try to set up themselves. It can be quite complicated.
I bet.
Yeah. I mean, some people do, but most people they'll go to their accountant or their financial advisor to organise the setup for them, and then they'll just instruct them, what to do. But they just need to be aware that if they're unsure, or if they need advice, they need to go to someone's licensed to advise on superannuation, to make sure that self-managed superannuation is the right superannuation vehicle for them. So just make sure that the person setting up for them is licensed to do so.
Yeah, right. Okay.
Otherwise, if they made up their mind that they want to set up their own fund, then they can just get their accountant and just instruct them to set up the fund, and then the accountant doesn't really have to give their advice on whether to do it or not. But ultimately, someone should be doing it for them, because it's quite hard to do it themselves.
Yeah, I guess one of the only circumstances where you'd be setting up yourself is if you are an accountant.
Yeah, that's right.
Someone like that who knows the ins and out of it. Yeah, right.
Or you want to save money, and there's probably a lot of people out there that want to save money.
Yeah, that's true. That's why they're like, "Oh, I'm going to got my hands all over this because I know exactly what I want to do and how." Yeah. I think you mentioned corporate trustees. Like, what are they, and how do they fit in here in this circumstance?
Well, every self-managed super fund needs a trustee, because it's a trust structure.
Yeah.
You need that trustee on top, which sort of acts as a custodian in charge of what's happening in the fund and operating and administering the fund, making sure that the members are doing the right thing and the fund is properly invested and administered and complying. But with self-managed super fund, it's different to a public offer fund where they've got a independent trustee, independent management from the actual members. The self-managed super fund, the trustee has to be also the member. So that's the law. So basically, the trustee or the management is also the actual member and the beneficiaries of the benefit. So that's a responsibility that the individuals have when they set up their own fund. They've got to be in charge of their own superannuation benefits. So under the rules, you can either have a corporate trustee, which is a separate company, or you can have individuals, which are the members themselves. So, and all the assets are then held under those names, whether it be individuals or a corporate trustee. So if a corporate trustee will be under the company name, so it could be XYZ Super Proprietary Limited. And then the members, mum and dad, will be the directors and the shareholders of the corporate trustee. So there's an extra layer. I guess you could say there's an extra layer of protection, or where the assets are actually separated from the individuals. So it's separate from it. I guess it's extra layer of protection, so you don't have a mixing of assets where they're held by individuals as trustees or individuals in their own name. And a corporate trustee, I guess, also as an extra level of asset protection. So if for whatever reason, if the fund is sued, or which very unlikely to happen, then there is protection with that the corporate structure. So the corporate structure will be liable rather than the individuals.
Okay, yeah. Right,
so it's extra level of protection. And the corporate trustee, this is the most popular trustee with a self-managed super fund because it's more flexible. So it allows members to come in and out without changing the names on the assets.
Because that would be a rigmarole, wouldn't it?
Yeah, that can be a huge admin impost.
Yeah.
And so if for example, someone passes away, obviously they can no longer be a member, then there's no need to change the name of the assets in the fund. It can continue as is with corporate trustee, whereas individual trustees, someone moves in and out of the fund, then you've got to change the name on the assets or bank accounts. So it's much better administratively to have a corporate trustee.
Yeah. Okay. I was going to ask which one's more popular, but you've answered that, so that's perfect.
Yeah.
And it kind of makes sense. Now that you've explained it.
I mean, there's an added cost in setting up a corporate trustee because you have to set up a company.
Yeah, of course.
And then you've got to do an annual ASIC fee, which is only $50 odd. So other than that, there's not much extra if you have a corporate trustee. But the benefits long term are much better than having individual trustees generally.
You were talking about, within a self-funded super fund, you have total control, or at least somewhat control, over where your investments are. Do you find people who have these funds, do they like to diversify with these, or are they, it's a nest egg, right? Like, are people more conservative with their investments?
Oh, yeah, very, very. It can be either they, with a self-managed super fund, one of the compliance requirements is that you have to have an investment strategy, and that has to be reviewed every year by the auditor. And on the investment strategy, the trustees need to outline what the fund will be investing in, what sort of assets, whether it be cash, equities, or property, and then how much diversification within the fund itself. How much percentage of the fund will be invested in certain assets, and then it also needs to outline liquidity. Does the fund need to pay out benefits, and are these assets liquid? Can they be cashed out at any time to pay benefits? Or if members are not in retirement phase and benefits are not being cashed out, assets can be less liquid. So, for example, they can be in property and say unlisted type of shares or assets. In terms of diversification, it's similar to, whatever you're investing in, your normal investment strategy, whether it be as an individual or another entity. Generally speaking, the investment experts prefer you to have a diversified portfolio, because then if one asset doesn't go well, then you're protected from downsides in your portfolio. So generally speaking, it's preferable to have a diversified portfolio and not have everything in the one basket, as I say.
Yeah.
But it's not necessary, and a lot of the trustees have quite concentrated portfolios because they might have only a few bank shares, but they might be a big money in each of those shares. But they're quite happy because they know they're in blue chip shares and they're paying dividends every year, and there's very low risk of that asset going bust. So
yeah, you got that consistency.
Yeah. So it's a fairly set and forget invested strategy, but it's fully invested and they're happy and very low maintenance. Or they could have just a property in there. A lot of people invest in self-managed super funds so they can invest in direct property, because you can't do that in a public offer fund. That can be a very concentrated portfolio, but a lot of people love property, and they're
especially in Australia, right?
That's right. And so they know property, so they like to have it inside of the fund and outside the fund, and they're really happy with that. And with the property market booming, it can be a very good strategy. But sometimes you want to be diversified, but sometimes you don't want to be over diversified, because if you've got too many assets, none of them really make any significant or difference to your portfolio. So your portfolio could be standing still, not moving, because there's very little movement. Because you might have, say, for example, 10 PHP shares or 1 BHP shares, but we could have and you can multiply that strategy over a number of shares, but none of those shares really do. They may be movement, but overall your portfolio is not really moving. It's not really losing, but it's not really gaining either.
Yeah.
So you can be dangerous of having too many assets in your basket as well.
Okay, well, we'll have to keep that in mind for when we're jumping into these kind of things. You said people might want to be taking money out of it, which that makes sense, right? But say mum and dad need to take more money out than son and daughter. How does that affect everyone's overall super fund?
Well, yeah, that's one of the issues when you're having mum and dad in the fund, but you're also having the kids in the fund. They're at different stages of life.
Yeah.
Mum and dad could be in this retirement phase or close to retirement phase, and the kids they're in that sort of what they call the accumulation phase, so they're building up their super funds. Mum and dad are about to take money out, so that's one of the issues where you have these family funds, because you might have multiple investment strategies, so you might have investments that are geared to mum and dad and may be more conservative and lower risk, and you might need an investment strategy where you might have assets for the kids that are more aggressive and more higher growth. So that's one of the issues that could cause issues when you have different generations in the one fund.
Yeah, like the balance there. There has to be some sort of agreement in the balance.
Yeah. But what one would normally see with these family funds is that you have the dominant, I guess, trustee or member, which is normally the dad, who's set up the fund and then brought everyone in, and he has set up the initial strategy, and he's been very successful. And he wants to, I guess, share that success with his children. So he gets the children in, and they benefit from the dominant trustee's investment strategies, investment analysis, and so forth. But with members in different stages of life, some members, the younger members, may be making contributions. The older members may be retired. They may be drawing money out as a pension to fund their retirement. But that's okay, because they're drawing money out of their portion of the fund. So it doesn't affect the younger members' portion, because everyone's portion, everyone's balance is set, and it just grows or decreases depending on earnings or money being taken out or contributions being made.
But it's your own part of the pie.
Yeah, that's right.
Yeah, right.
But it may affect liquidity issues in terms of you may need to sell down investments to fund your person's pension payments. And so there may be investments issues in there because that could be a good investment. So, but then you need to sell it to pay down mum and dad's benefits.
Yeah,
that could be an issue.
I mean, it sounds like it's constantly a moving beast that needs to be maintained.
Yeah,
and you were talking about the things that must be done every year. Are your earnings from these investments are they taxed or are they treated like a normal public super fund?
Yeah, the earnings are they treat like a normal public super fund. So all the members have earnings attached to them and allocated, based on the balance or the value of their benefits. So it's all pro rata and allocated or accrued to each member based on the size of their benefits. So now exactly the same as a public offer fund.
Yeah.
How much you got in the fund and how much you earn will be dependent on the balance in your fund.
Yeah,
so
sure.
Exactly the same.
Okay.
In terms of taxation, almost the same too, because the self-managed super funds also get taxed. It's a tax vehicle. Generally taxed at 15%. So same as the public offer fund.
Yeah, okay.
So that's generally why they're so popular, superannuation is so popular, because of the low tax rate. And the earnings are taxed, 15%. Capital gains are also taxed. They're generally taxed at 15% or 10%, depending on how long you've held the asset in the fund. So if you hold the asset in the fund for more than 12 months and then sell it, then you get the reduced tax of 10%. And also the great thing about superannuation, once you're in retirement phase and you start to turn on your pension, so you convert the fund into a pension fund, then the earnings on the assets that pay the pension are tax-free. So that's a huge benefit of superannuation, and in particular self-managed superannuation, where members could be in retirement phase drawing a pension and their earnings are in the fund are tax-free. And if they've got imputation credits, so they've invested in Australian shares that are paying fully franked dividends, then those imputation credits are fully refunded in the self-managed super fund. So you could be getting a decent refund every year if you're in pension phase.
Yeah, okay. So it definitely changes. What happens if you are part of this fund? And I want to sort of focus on the family thing. What happens if one of the members passes away? What happens to their part of the super fund?
Yes. Well, their part of the super fund needs to be they need to be taken out as a death benefit. With superannuation, it's treated as a separate asset on the person's death, so it's not part of their estate automatically. It's not so it doesn't form part of probate like normally other assets do. So it's treated separately. So it needs to be paid as a death benefit. So generally what happens is each member would have a nomination on their superannuation account. Similar to a public offer fund, you're asked to nominate who you want your benefits to be paid on death.
Yeah. And
so with a self-managed super, same deal happens.
Okay.
You complete what they call a binding or non-binding death benefit nomination, and under the super rules, that needs to be paid out to a dependent, which is generally a spouse or a child, or it could be paid to your estate. Once you die, it needs to come out of the fund. In some instances, it can stay in the fund. Generally, if your spouse is also in the fund and they've survived you, they can potentially take and you've nominated them as a beneficiary, they can take your benefit as a pension. So
right, okay.
So if you're for example, if you're already taking a pension, it can revert to your spouse on death, and they can take over your pension. Or if you're not in pension phase, your spouse and your spouse is the recipient or your beneficiary, they can nominate to receive your benefit as a pension within the fund rather than taking it out as a lump sum. Because once you take it out,
it's out.
as a lump sum, it's out, and it can be quite hard to get it back in because it has to come back in as a contribution.
Of course, right.
But if you nominate your children as a beneficiary, it has to come out. It can't stay in the fund unless if they're under 25, it can be paid as a child pension.
Okay.
Yeah, so it can be paid out if the child is over 18 but under 25. It can be paid as a child pension. It doesn't happen often, but it can be paid out that way. But generally, if it's going to a child, it comes out as a lump sum.
Yeah, okay.
And it gets taxed. If it goes to what they call a tax dependent, which is your spouse or a child under 18, it comes out tax-free in their hands.
Well, gosh, there's so much to know about. I mean,
and
if
you take out the benefit before you die, so if you know when you're going to die, then it comes out tax-free to yourself if you're over, say, 60.
Okay, if you've got the fortune telling,
or
the crystal,
or if unfortunately you've got a terminal.
Oh yeah, of course,
illness,
right,
correct.
So I mean, we know people put shares and property into these funds, but is there anything else that people can or have put in the past?
Yeah, that's right. It's interesting that you mentioned that. Yeah, that's another reason why people set up self-managed super funds, because they can invest in things that they can't normally do in the public offer fund. Or it can be quite unusual assets. We've got instances of people investing in gold bars and bullion bars and platinum bars and putting it in their safety deposit boxes, people investing in artwork and sculptures or things like that. But they can do all that, or they can invest in memorabilia and things like my 1988 NRL football card collection could be worth Don
millions,
Bradman's
right?
Cap from the 1910 Test with England can be that. Could be Dennis Lilly's aluminium bat.
Yeah,
something weird like that. It can be really weird and wonderful things, but and it can be a great investment because quite often the trustees are experts in these fields. They could be coin collectors and they know what really is valuable and what will grow and over time. So it can be a great investment, but there's always a but. It does increase the compliance risk for the fund.
Oh, really?
Yeah,
why?
Because there are additional rules if you want to have these things in your fund. So, for example, if you've got artwork, you can't have it in your lounge room or in your bedroom because you can't be seen to be enjoying your benefit before retirement. So
okay.
It needs to be stored in a separate area
where you can't look at it.
Correct.
Huh.
Yeah.
Interesting.
Yeah. So, John, you can't really store it in your own home.
So you just have to have a photograph of it. Look at it fondly every now and then.
And it has to be individually insured as well.
Ah, okay.
Yeah. So if you've got gold bullion in your safety deposit box, then that has to be insured, even though it's locked away and very hard to get to. It still has to be individually insured. Wow. So there's all sorts of rules. And then the other thing, the auditor needs to see these things.
Like visibly?
Yeah, they need to see that they exist. And so they need to sign off on the audit report that you've got these assets and it's not in your bedroom and it's not somewhere you can enjoy it and so forth. So they need to physically see these assets and sign off. And quite often for auditors, they find that difficult and they won't sign off on the fund. So it can be a hassle if you have all these unusual or unique assets in your fund because the compliance costs can be very high in keeping them. So it's all well and fine and romantic to have that, the vintage guitar in your self-managed super fund, and you can't play it. You can't pull it out and
say, hey, look at me, I'm just like Jimi Hendrix.
No, you can't play lead guitar.
Oh my gosh, I've learnt so much today, Andrew. This has been amazing. And also now I'm intrigued to see what you can play on guitar. But that might be for a separate
that's
podcast.
Right. That's a different podcast.
Yes.
Sorry.
It's a different one.
Yeah.
Andrew, thank you so much for coming on and just giving us a wealth of knowledge about this. Much appreciated.
All right. Pleasure, Leah. Thanks very much.
Andrew Yee's expertise and knowledge is part of HLB Mann Judd's personal wealth management services. For further information, please visit our website hlb.com.au.